Hi, ladies and gentlemen, I can see we are 60 something and we have invited all our classes. Where are the other students? So remember, we're looking at what we call adjusted present value. APV, adjusted present value method, APV, and specifically, this is the question that I'm doing. Specifically, this is the question that I'm doing. So specifically, the question that I'm doing here, which I actually started doing yesterday for the students who were there in our yesterday's class. This is the question that we were doing, if you remember. This question here. So if you look at this particular question, ladies and gentlemen, just a minute. All right. Then you'll be able to see great things here. We are told ladies and gentlemen, we are told that rounding company is a company currently engaged in the manufacture of baby equipment. It wishes to diversify into the manufacture of snowboards, a company that wants to diversify to a new industry. Then in this case here, that new industries, gearing ratio, new industries, beta factor has to be ungeared. So you're told here, it wishes to diversify into the manufacture of snowboards. The investment details, the company's equity beta is 1.27 and its current debt to equity ratio is 25. Another background of class is ongoing. Okay. Another class background is ongoing. Another class background is ongoing. Let me sort it out a little bit. How about now? Are you still hearing it? Are you still hearing it? How about now? Are you still hearing it? Yeah, stop, right? Echo at the background. Echo at the background. Just 1 minute again. I make everything good. I hope it should be okay now. I hope everything now should be okay. Everything now should be okay. Again from the beginning. The rounding company is a company currently engaged in the manufacture of baby equipment. It wishes to diversify into the manufacture of snowboards. The investment details, the company's equity beta is 1.27 and its current debt to equity ratio is 25:75. However, the company's gearing ratio will change as a result of the new project. Firms involved in snowboard manufacture have an average equity beta of 1.19 and an average debt to equity ratio of 30:70. Assume that the debt is risk-free and that the risk-free rate is 10% and that the expected return from the market portfolio is 16%. The new project will involve the purchase of new machinery for a cost of 800,000. So this new project is about a new machine that you're going to buy for 800,000 net of issue cost, which will produce annual cash inflows of 450,000 for 3 years. At the end of this time, it will have no scrap value. Corporation tax is payable in the same year at the rate of 3%. Remember, tax here is 33%. The machine will attract tax allowable depreciation of 25% per year on a reducing balance basis, with a balance allowance at the end of the project life when the machine is scrapped. Ladies and gentlemen, we have here the new investment will be financed as follows: 40% debt, which is bond, and then rights issue of 60%. The issue costs are 4% on the gross equity issued and 2% on the gross debt issued. Assume that the debt issue costs are tax deductible. Calculate the adjusted net present value. So now how do we get this adjusted net present value? Very easy thing. I'll get this while sleeping. To get adjusted the net present value, we shall get what we call base NPV over what we shall call financing effects. Of course, I began doing this question with some students here, so I'll not start exactly from where I'd done. What I will do here, I'll come straight away and look at a few things. You see, how do I get this base NPV? Get base NPV by discounting cash flows of the project. Cash flows from the project using KU of the new industry here. Using KU of the new industry. KU of the new industry. Snowball of the new industry. So please, first of all, write up to there, and then you put your thumbs up once you are through. All right. So in this case here, we shall get the base NPV by discounting cash flows from the project here, using cost of equity of unlevered farm. Cost of equity of unlevered farm of the new industry. Now, ladies and gentlemen, let's get information about the new industry. This is a low-hanging mark now. Information about the new industry. It's called, in this case here, snowboards. Rounding company is a company currently engaged in the manufacture of baby equipment. It wishes to diversify into the manufacture of snowboards. I really love this, because here they want to go to something new. So there is a new industry involved. So the company's equity beta is 1.27. So that becomes irrelevant, because we are playing an away match. And its current debt to equity ratio is 25 to 75. Again, this is what here kind of useless for now. However, the company's gearing ratio will change as a result of the new project. Firms involved in snowboard manufacture have an average equity beta of 1. So firms involved in what? Snowboard. And snowboard is what here? Our new industry, our new venture. So firms involved in snowboard manufacture have an average equity beta of 1.19 and an average debt to equity ratio of 30/70. Very easy, ladies and gentlemen. What I will do here, ladies and gentlemen, is a simple thing, very simple thing. So they have told me that this firm is going for a new venture, it's going to a new industry. Let me walk with it to that new industry. I'll start by walking with it to the new industry. So let's walk with it, the new industry. That's what we do. You visualize that happening. So walk with it to the new industry. Walk with it to the new industry. Let's walk with it to the new industry. So then the new industry, what do we have there? This new industry, which in this case is that industry of the snowboards. The snowboards has a better equity. Better equity of what here? 1.19. and it has a debt to equity ratio. Debt to equity ratio that I've forgotten. It has a debt to equity ratio that I've forgotten here. A debt to equity ratio that I've forgotten of 30 to 70. 30 to 70. 30 to 70. 30 to 70. So debt is 30 to 70. Now, please, ladies and gentlemen, listen and listen to me very well. This examiner was quite lenient because he told us that this is better equity. This is better equity. Most examiners will just tell you that that is beta. So it's useful to know that, we have got two betas. We have two types of betas. We have beta assets, and then we have what we call a beta what here? Beta equity. Now, beta assets is that type of beta which normally is used by organizations that are ungeared. So this one is for the ungeared farms. It's for the ungeared farms, and that is why normally we call it beta equity but unlevered. Beta equity but unlevered. Beta equity but what here? Unlevered. So it's used by farms, in this case here, without debt. It is used by farms without debt. And then now we have, in this case here, this beta equity. So this beta equity is also known as the total beta. So this one is the one that is normally used by organizations that have got what here? Debt. Organizations that have got debt. That's why we normally call it beta equity over a levered farm. Beta equity over a levered farm. This one here. So according to your understanding, will this one here be Bell or will it be Bell? According to your understanding, this one here, will it be Bell or Bell for the new industry? Because at times the examiner will give you these things interchangeably. According to your understanding, will it be Bell or Bell? It will be Bell. It will be Bell because they've told us that this snowboard company has debt in it. It has both debt and what here? Equity. So if it has got both, so it's total, so it's Bell. So this is Bell. But you see, as I told you up there, we are required to discount the cash flows of this new project here using KU, using cost of equity over unlevered farm. Cost of equity over unlevered farm. So then the very first thing for us to do will be for us to change this Bell to Bell. So this Bell for the new industry. If in this case they gave us Bell directly, then I would have been safe. But here they have given me Bell. So I have to change Bell to what? To Bell. We have to change Bell. So change the Bell to Bell right there for us. Change the Bell to Bell. Change the Bell to Bell here. Change the Bell to Bell. Change the Bell to Bell. Using Hamada's model. So we are going, ladies and gentlemen, to change the Bell to Bell using what we call the Hamada's what here? Hamada's model. So is there anybody who is able to remember this Hamada's model? Is there anybody who is able to remember this Hamada's model? Is there anybody who is able to remember this Hamada's model? Very good. So the Hamada's model, ladies and gentlemen, in this case here is Bell equals Bell into 1 plus debt over E less taxation like that. Less tax. So we want to get, in this case here, Bell. All right. Thank you very much. So in this case here, then the Bell is 1.19, which will be equal to Bell that we not know, into 1 plus debt is 30, equity is 70. Do we have the tax rate? Do we have the tax rate here? Where is the book? I'll be able to give you the big book in a minute. So the rate of taxation is 33%. So that 3%, then I can only multiply this with 0.67, because you see 1 minus tax. It's 1 minus 0.33. It will be 0.67 like that. So can you kindly do me a favor? In 4 decimal places, is there anybody who can tell me this one here will give us what? Is there anybody who will be able to tell us that this one here, you consolidate everything in the brackets? Please, everybody must punch their calculator, please. Now we are in injury time. Injury time, there is no procrastination. Injury time, every ninja should be able to throw kicks here. Every ninja should be able to throw kicks here. So we have here V. V, she's giving me 1.2871. So we have here 1.2871, like that. That's BEU. Or rather, that's so we need to come and make BEU the subject of the formula. So BEU, what do we have here as BEU? Therefore, BEU will be equal to, if you make this BEU the subject, it will be 1.19 all over 1.2871, like that. So can you kindly go ahead and give me the BEU? Kindly go ahead and give me the BEU, 0.9246. 0.9246, 0.9246, like that. I would want to pause a little bit and have the students who have this particular book sharing that book in our respective WhatsApp groups. Let's share that book. Let's share that book in our respective WhatsApp groups, the paid groups. Somebody go to the paid groups there and share. Go to the paid groups and share. Already Wilfrida has done it. Just a minute. So then we have been able to get what we call BEU. Now, please listen. There is a difference between this APV question and the other normal NPV questions. If it was a normal NPV question, after getting this BEU, I would have still now used the information of the existing project to get what we call BEL for the existing project. It would have been a three-step project. But now this question is about APV. This question is about APV. This question is about APV. So if I come here so that this ninja can see the page number, this question is about APV, 243. This question is about APV. Calculate the APV, adjusted present value of the project. So if it is APV, the moment you have given me BEU for the new industry, please go ahead and give me the KU of that industry. Go ahead and give me the KU. So in this case, we shall not reverse this to BEL of the existing project. No, we shall straight away go ahead and ascertain the KL, not KL, but Q of the new industry. So give us the KU of the new industry. Give us the KU of the new industry. So how do we get this KU of the new industry? So to get this KU of the new industry, we shall as well, we shall as always use CAPM. We're using CAPM. So is there somebody who is able to remind us in this case here what CAPM is about? Anybody who is able to remind us that the formula of CAPM? Anybody who is able to remind us the formula of CAPM? Please, somebody help Nina, because I'll not be able to really get back all the time. And you guys ninjas are here to be able to help these other ninjas who are coming now. So CAPM, I know CAPM is all about investments. And I know that serious ninjas, serious investors, whenever they are thinking about investments, they must always start with risk-free. So we always start CAPM. Serious ninjas must always start with risk-free into expected returns of the market minus risk-free, like that. And then I'll multiply by what here somebody. Multiplied by beta. But now the question is, which beta? Thank you very much. Multiplied by BEU. Not BEL. Here we can't use BEL because we want KU. We want KU of CAPM. So in this case here, come here and multiply this with BEU, like this. Ladies and gentlemen, are you able to see the risk-free rate of return in that question? Are you able to see the risk-free rate of return? A REF stands for risk-free rate of return. So the risk-free rate of return has been provided somewhere here. The risk-free rate of return has been given. This is 10%, this is 10%, this is 10%. Plus, are you able to see the expected return of the market? Are you able to see the expected return of the market? Market portfolio is 16%. Are you able to remind Mwalimu what BEU is? Are you able to remind Mwalimu the formula of, or rather the value of BEU? The value of BEU. BEU, we got it up there, 92.46. So ladies and gentlemen, are you able to move the speed pretty fast, knowing that this is 0.1? In your calculator, plus into brackets 0.16 minus 0.1, you close, times 0.9246. Give me the answer. Please give me the answer. So CAPEM, according to some ninja here, it is 15.54. 15.54. 15.54. So up to there, ladies and gentlemen, is there somebody who has been able to pick something? Because that is the most important step under APM. Those steps are basically like soft targets. I want to knock them down as a wonderful ninja. Most students will really lose it here. And please practice. You know, you can't go to an AFM exam without practicing Hamada's model. Please practice. Practice makes perfect. And we can check the answer here to see, for you to see that you have done some quite a nice job. For you to see that you have done some quite a nice job. For you to see that you have done some quite a nice job. Here it is. All right. So I hope you have seen the answer. So you guys are doing well. You can see here, 15 point something, 16%. They decided to work with 16%, but us, we shall work with that 15, the figure that we have. Let's work with it, the figure that we have. Now, ladies and gentlemen, from there, what do you think will be the next thing to be done? Now you're thinking like a real ninja, strong person. What do you think will be the next step? Now that I have the cost of capital that I will use, because you see, KU is the cost of capital that I will use. What will I use it for? For discounting, isn't it? For discounting. For discounting, yes. So, but I don't have cash flows. So first of all, I have to look for cash flows. So first of all, I have to look for the cash flows. Of course, I've seen somewhere there them talking about depreciation. So for me to get cash flows, I need depreciation here, because also the rate of tax has been provided. Whenever tax is given, depreciation is relevant. So another free mark here, 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 another free mark here. So we shall be able to get depreciation. Goodness, with AFM, all the workings have got marks, depreciation. So I would want year one, depreciation for year one. Remember, they have told me that this machine is going for 800,000. This machine is going for 800,000. If you ask me, I can rather we do without those thousands. We do without them. We strike them off. So in this case here, the machine, brand new, is 800,000. And what is the rate of loss, rate of depreciation per annum? Have they given me the rate of depreciation per annum? 25%, isn't it? 25%, right? 25 or right? 25 or right. So I should be able to pick the other book, not the one that has got so. Gone again. Starving me. Many items that I've opened there, but we shall overcome. Firm believer of overcoming. Firm believer of overcoming. We shall overcome. Okay, so here we are. So they have told us that the new project here will cost 800,000, which will produce annual cash inflows of 450,000 for 3 years. At the end of this time, it will have no scrap value. And then they went down here and of course give me some pointers to tell me that I need to calculate depreciation. They've told me in this case here that the tax rate is at 3%. So whenever tax is given, then depreciation must be computed. They are natural sisters. The natural sisters. The machine will attract tax allowable depreciation of 25% per year on a reducing balance base. So we're using reducing balance method. Whenever the examiner is silent about the model we shall use for depreciation, we shall always use straight line method. We shall always use straight line method. But whenever they tell us to use reducing balance, no problem. So here one, depreciation will be 800 times 25%. We're losing 25% per annum. So that gives me what figure somebody here? 200. Thank you very much. So we go to year number 2. Remember, it's about reduced balance. So it will be 800 minus 200 multiplied by 25% because it's a reduced balance method. 150. And then there is something that no ninja will ever get right. Year 3, remember, this is a project that has got 3 years. Year 3, very few students in Kenya will be able to get the last year, how to handle the last year. Many accountants in Kenya do not get this correctly. I think it is a system that was not taught very well in FA section 1. FA section 1. 800 less 200. 450. 450 is the correct answer, yes. Because you see here, year 3, you can't, the last year we can't apply the percentage. So the last year, what we shall do, we shall take what we started with, minus what we have lost in year 1, minus what we have lost in year 2, minus any scrap value. So the scrap value takes care of the percentage. We shall never, ever apply the percentage in the last year because the last year, we will get what we call the balancing allowance, balancing figure. So is there somebody who is able to give me this balancing figure? Somebody who is able to give me this balancing figure? Somebody who is able to give me this balancing figure? So they're saying it is 400 what year? They're saying it is 450. So they're giving me a figure of 450 like that. Or if you hate this method for getting the last year, if you hate this method, there is no problem. What you could also do, you know that at the end of the day, this thing has to come down to 0. The 800,000, there's no scrap value. So meaning that by the time we are finishing 3 years, then the depreciation amount will be 800, out of which 200 has gone there, 150 has gone there. Then what will be the balancing figure? It will be 800 minus whatever we have here, which will end up giving me 400 and what here. But the better method, ladies and gentlemen, is this method that I'm giving you, where you take 800 minus what we lost here, minus the 150 there, and then we have here minus the scrap. They have told us that this machine had a scrap of what here? Has a scrap of 0. Has a scrap of 0. Has a scrap of 0. I can't understand. Are you guys able to hear Mwalimu? Are you guys able to hear Mwalimu? This guy who is saying is muted. Does he want to ask? When you want to ask a question, just put up your hand because trust you me, Alango. If I give members here an opportunity to unmute themselves, the class will not go on because they are, again, accountants here will not know how to mute themselves. Do you want us to try? Like I give you a chance of, I open the room you hear. Would you want us to try that? Would you want us to try that? So when you have a question, please just put up your hand and then I'll be able to unmute you. I'll be able to unmute you. It will be disastrous. It will be disastrous here. It will be disastrous. There are accountants who have never taken time to understand how to, until something, or different matter, until something in this case here happens to them in the near future. To them in the near future, that is when they will be able to do what here? They'll be able to know the importance of muting and the importance of what here, the importance of shutting their camera down. When it happens like this CNN guy who was reading news, quite a useless man. This guy with a suit up here on top, and then under there, a boxer. So he has finished, in this case here, reading the news, everything, and then there he is saying, finished. He's walking like that, his camera being on. He had to resign immediately. International disaster. So always professionally, you must know how to mute, and you must know how to do what to shut down your camera, lest things will happen. 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 I have never understood why CPA guys don't take it, because now we are in this era of what here? This era of, virtual reality, virtual things. So we must really take this thing serious. We must take this thing serious. We must take this thing serious. Okay. Yeah, like evening students, Evening students. I don't know why guys are talking about evening students. I think there is an event which happened there, isn't it? Not even the year alone. Even like last time I was teaching a BDS student, yeah, melala tu na mega camera on. Hey, kashindo sasa na huyu. Na hajui. Anaiona nguvu na amehakisha paka taa sasa. Hajui. Lakini sasa makosa sio yake. Ni vile tu hajui mambo ya Zoom. Please take a time and understand. It's a small thing. After all, we are not supposed to mute you totally. We are not supposed to mute you totally. Trust you me, we are not supposed to mute you 100%. So now let's continue. Now everything is sorted out because now students here have understood the meaning of what here being muted. Now students have understood. But now they will always be very, very careful. All right. Now, the gentlemen, then I would want you guys to do me a favor. Please do me a favor here. Once you get these depreciations, you need to give us the depreciation tax benefit. Depreciation tax benefit. Just by the side here, give me the depreciation tax benefit. Depreciation tax benefit. Or a depreciation tax shield, the same. Remember the rate of tax here is at 3%. So please multiply these figures with at 3%. Multiply these figures with at 3%. Multiply them with at 3%. So is there somebody who is able to give us these figures? Depreciation tax benefit, depreciation tax. Depreciation tax. Yeah. How to use Zoom. Yes, we shall be able to train you guys after exams. After exams. So the first one is 66. The second one. Juliana, can we kill those zeros? Can we kill those zeros? So we work with the same figures. Let's kill those zeros. Now we're getting 49.5. At the morning class, kuna mtu analia. I don't know. So 148.5, okay. Then I'll have to take these things seriously. But I've also seen it at my workplace, Zoom messing people. Nasikia tu mtu from nowhere amesema tu boss wangu ni mjinga. Hai. Tu boss wangu ni mjinga. Na ameweka microphone on. Aya. Your physical education. It's just etiquette. Go to YouTube and learn how to use Zoom. All right. So nimevuta haraka, but I believe up to there now we are okay now. I believe up to here we are okay. Is that okay? Up to here now we are okay. Now we can continue. Now, ladies and gentlemen, from there then, I'll be able to think about now my cash flows then. Because now I have already what here? I have already depreciation. Now I'll be able to think about my cash flows. So has this examiner given me cash flows? Has this examiner given me cash flows? Oh, yes. The new project will involve the purchase of new machinery for a cost of 800, which will produce annual cash inflows of 450, because I'm cutting the 3 zeros. for 3 years. Annual cash flows at the end of this time, it will have no scrap value that you have already used. So how will I treat this question? Will I treat this question as a PVFA or a PV question? Will I treat this question as a PVFA or a PV question? PVFA or PV question? PVFA or PVFA? It is a PV question. Please never confuse this. This is a PV question. So we have 3 years, year 1, year 2, year 3. So in this case here, we have cash inflows. We have cash inflows of 450, 450, 450. Why am I not treating this as annuities? I can't treat this as annuities because I have a depreciation tax shield or a depreciation tax benefit, which has got different amounts in different years. I'm going to discount the candle and discount because that's also a possibility to discount pia depreciation tax benefit candle. Hapana. Tuliambiwa Mwalimu David lazima ulipata swali kama hiyo akakwambia kwamba ukiona, ladies and gentlemen, at the end of the day, whenever you have like a depreciation tax shield or one metric is different, when one metric is different, then you should be able to do what here. Now, ladies and gentlemen, from there, what do you think will be the next thing here? What do you think will be the next thing to do here? What do you think will be the next thing to do? They're great. Your ninjas who don't fear. We less cost. You know, they've given you cash inflow. The only cost they haven't subtracted here, which very few students will remember. Very few students will remember. It is only tax. You see, if they were to tell you cash flow, cash flow, cash flow, you know, this is cash inflow. What is coming in. So whenever it's cash inflow, it's different from cash flow. So this cash inflow, it means they have not deducted tax. All right. So coming, in this case, tax. So tax is 33%. Very few, because they have used the word, look at this. Look at this. Add back depreciation. No, that method, you're not using it. You're using it here. You see here, they're talking about produce annual cash flows. Niwakora, produce annual cash inflow. So come on, cash inflow. Come on, cash inflow. Then you need to give Zakayo his share. So give Zakayo his share. Give Zakayo his share. So you're able to give me this figure very fast, right? Are you able to give me this figure very fast, right? 148.5. So 148.5, 148.5, 148.5, 148.5, deduct. Here we end up somebody add back, we try to call the method of depreciation tax shield. So in this case, you come and say add depreciation tax benefit or shield, whichever name that is working for you. The first one I remember very well was 66. The second one I cannot remember. The second one ilikuwa inakuja ngapi woye? The second one ilikuwa inakuja ngapi woye? Aki woye, they are not talking to me. 49.5 from Alex Ogega. 49.5. Thank you very much. How about the third one? 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 148.5. 148.5. Ladies and gentlemen, these are your cash flow to be discounted now. So these are your cash flows, operational cash flows to be discounted. So is there somebody who has these operational cash flows to be? So you are taking this minus this plus this. So abracadabra, we are feeling nice, and today I'm a happy man. Today, and the way I've worked hard since morning. The way I've worked hard since morning. Since morning, I've worked very hard. So abracadabra, are there students who are getting figures? Of course, them they're rounding off highly, but are there students who are getting the figures like this? 367 something, 351 something, 450 something. Are there students who are getting? Could be close, plus or minus 1, you know, because of rounding off errors. Year 1 should be around 360. I'm not getting your figures. I'm not getting your figures. And if there is a day I would want to help you guys, it is today. But you guys must give me 367.5, 367.5, 367.5, and then we have 351 and 450 ninja. 450 and 450. So up to here, ladies and gentlemen, are we together really? Are we together? Are we together? This is very correct. So now the cash flows, we can discount them. So let's go ahead and discount them. So we shall get our PVs here. Remember the rate was 15 point something. Was it 15.56 or something? 15.5 something. Because we are discounting this using Q. We are discounting this using Q. We are discounting this using Q. It's 15.54%. And we know the formula is 1 plus R raised to negative N. So it is 1 plus 0.1554 raised to negative N. So it is here. It is 1.1554 raised to negative 1. 1.1554 raised to negative 2. 1.1554 raised to negative 3. So do you have these figures really? Do you have these figures? Do you have these figures? According to moja kidogo, somebody mestuka kidogo, nione anasema swali gani nimsaidie. Maisha ni kusaidiana. Mtabori umepotea wapi wewe? Umesema tu hujasema swali ni gani basi. Umesema uko juu. Ama unajaribu kumaanisha kama ile unasema nasikia 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 Mteni karibia. We shall overcome. We shall overcome. All is well. 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 All right. So the first one here is maybe that in box up or unajulianga wapi vitu mwalimu. Unajulianga wapi hizi vitu. 07491. 07491. Aha. Ya pili 06483. Iko imekatana. Tuanze na ya kwanza. Wrong. So hii ni wrong. Ya kwanza ni wrong. Ya kwanza ni wrong. Wrong. Tuanze ya correct sasa. So tuanze ya kwanza. So ya kwanza ni tuanze ya kwanza kabisa 0.8654. 0.8654. Hiyo ni ya kwanza kabisa. Tuende kwa ya pili sasa. Ya 2 now. Ya 2. 7490. From there, ladies and gentlemen, we go to number 3. Year 3, 6483. 6483. Now, from there, ladies and gentlemen, you should be able to come and give me present value. So present value, now you are taking this figure times this. Can you do me a favor? In your exams, you guys will be writing whole numbers because we'll be having all the time. But me, I don't have all the time. Are you able to give me like a whole number for each one of them? Are you able to give me like a whole number for each one of them? 318. So this is 380. Just give me a whole number. Just a whole number to make my work easier. A whole number. 263. Mozoni Maina. 263. From there, we go to the last one, which is 450 times this. 292. So after getting this, what do you think will be the next thing to do? We add, isn't it? Because now they are present value. Now we add their present value. So you add, give me the total PV. Come here and give me the total present value. So you add, you give me the total present value. So the total present value, when you add the 3, 292, yeah, 873. 873, and then you come under less initial outlay. Are you able to remember the initial outlay? Are you able to remember the initial outlay? 800, isn't it? So the initial outlay, ladies and gentlemen, they're saying Mwalimu initial outlay is 800. The initial outlay is 800. So then that will give us a base case NPV of how much? 800 here. 800 there, you subtract, it will give us about 73. Which will give us about 73. So in this case here, don't start making comments here as regards suitability, viability, nothing. This is an APV question. You haven't yet finished. You will get a ninja in this case after they get this NPV. The only thing they know is to write viable in capital letter. No. Come to leave. Bado. Stanley wewe. We shall overcome. We shall overcome. So this examiner, of course, got 60 something, isn't it? We shall overcome. This examiner got 60 something simply because of what year he used. In this case here, 16% instead of the. We are more accurate than him. We are more accurate than him as we decide to use the way it is, the way it is, the way it is. So this is the first thing we have done. So we've been able to get the base case and the base NPV. We call it the base NPV. Base NPV. Assuming that the company does not have what here, any debt. Does not have any debt. That's why we have been able to discount those cash flows using K. We never used like WSCC. And that reaching here is not a very, very tough thing. What normally will disturb students is getting depreciation. Once you have depreciation right, and then you remember also to deduct tax, whenever they tell you cash inflow, always deduct tax, then you are good to go. You are good to go. So can I have this ninjas? Can I have this now, ninjas? We got the next thing. Yes, thank you so much. So now I can come and rub this, and come and rub this. And by the way, we should have agreed between ourselves. How many hours are you giving this ninja for AFM today? How many hours are you giving this ninja for AFM today? Because I'm not coming for AFR. I would want after AFM, I saw some leadership, some LM students were able to contribute for me. Those guys are not a joke, Rose, and these guys are not a joke. They were able to contribute for me. Kenya shilling 7,000, imagine. Kimchezo, and I think you can Kimchezo namna hiyo. Those are leadership and management students. Mwalimu leo muongea sana namna hiyo. So pia ningetaka sasa basi vile mmenibariki namna hii, si leo nibebe familia yote nipeleke out for just dinner, nice dinner. Nisikuje refare. Ama nyinyi mtaka kuhudumia mwalimu. Mtaka mwalimu akae hapa. So hao wanafunzi wamefanya kitu nzuri no. I don't know what you guys will do, AAA. Please, I cannot leave this question up. With all humility, I can't leave this question hanging again. With all humility, I have to finish this question. And I would have wished really to continue up to around 4 p.m. How did you put this class? And I made an announcement. Pema. I thought I told you guys to do double. Hata mtu akatuma timetable kwa group. Ama nyinyi mngeambia mwalimu tuko na AFM. Ama nyinyi mnakubali tu lesson yoyote tu. Hamkupanga kwa nini sasa? Kwa nini hamkupanga hivyo? Yeah, because ukisema tuko na class 2 p.m. na sasa ni 1:50, sitakuwa nimemaliza hata sikutaka kumaliza. Nataka kufanya bado kitu kidogo kwa money market. Amwezi ambia mwalimu 1:3 at the worst case ama 2:30 basi. Mwambie mwalimu mwanze 2:30, mwambie kwa group mwalimu with due respect, let's start at 2:30 and we really appreciate mwalimu your work, but let's start at 2:30. Tumekubaliana? Yeah, we continue. All right. Now from there, we look at what we call the financing effects. Now these financing effects normally will have issues here in many ways. So we look at the capital structure. So we have here equity. We have here debt. Remember, in total, the project is a project of 800,000. Of which equity is what percentage? Is there somebody who remember as equity? Equity is what percentage? Great. Equity is what percentage? Uongo, oh yeah, uongo. Uongo, maheni. Uongo. Leo mko wengi. Leo tuko wengi sana. Remember, they always tell you, I know you guys are making reference to the new industry capital structure. No, but thank you for trying, really. You guys are great ninjas. So here, they will always tell you, come down here and see what they have told you. This will be the capital structure of the project that you've gotten. The new investment here will be financed as follows: 40% bonds, that is debt, 40% bonds, rights issue of equity. So rights issue, of course, that is what your equity. So equity 60%, and 70% to Wanikia. That we're able to do very well. So then now what we will do is to come and use this structure here. So equity is 60%. So are you able to give me these figures? Are you able to give me these figures? I don't know whether they're getting the 25 over 75. No, 480. So this is 480,000. 480,000. How about the second one? How about the second one? How about the second one? 320,000. 320,000. But now remember, these figures are a net of issue costs. So now you're able to give me the issue costs. Issue costs and the total. Yesterday, I gave you a very good shortcut of getting those issue costs. I gave you a very good shortcut of getting those issue costs yesterday. The issue costs, remember this figure, the 800,000, first of all, was net of here. The new project will involve the purchase of a new machinery for a cost of 800,000, net of issue costs. And then the issue costs have been given down here as a percentage. So gross equity, the issue cost for equity is 4%. So equity is 4%. And ladies and gentlemen, we have in this case here 2% for debt. 2% for debt. Not many students in Kenya can get this correct. Not many students in Kenya can get this correctly. So in this case here, this will be 4 times what here? Well, let's say 4 times 4, 80,000. And the 2 times 3, 20,000. Will I do that? Will I do that? Will I do that? No, no. Because you see, this for 80,000 is net of the 4%. So if it's net of the 4%, it is at 96%. So basically what you do, you simply, so this one will be 4% times 480 divided by 96%. Divided by 96%. So if you are following, this other one will be divided by which percentage? Because when they use the word net, it has to be also the net percentage. So this down here will be out of what percentage? 98%. Please never forget this, because they are net off. They are also net off percentage-wise. So it's like saying that this 480,000, the 480,000 is at 0.96. What about 100%? What about, I only want the issue costs, and issue costs there, they are 4%, like that. So can somebody in this case here use the abracadabra to give me the issue cost for equity? Please give me the issue cost for equity. Give me the issue cost for equity. So equity, somebody is telling me that Mwalimu equity is 20,000. 20,000. So meaning that for equity holders, we must ask for how much? For equity holders, we must ask for 500,000. Because now we'll add this for 80 plus 20,000. You see now, if you take 4%, somebody, take 4% of 500,000, you will get this exact 20,000. But you can't take like 4% of this 480,000. That would be very wrong. If you take 4% of 480,000, you can't get. But if you take 4% of 500,000, you ninja, you will get this 20,000. So when you go to a question, and then you are told that this figure is net of 10%, it's net of 10% issue cost, then the issue cost will be what over what? The issue cost will be what over what? If it's net of 10%, it will be 10% over 10% over 90, 10% over 90, over 90. Just like, for example, if somebody wanted this total, if somebody wanted that total, this is how I would have done it. If somebody wanted that total, I would have done it very well. I know that the total is at 100%. I know that the total is at 100%. So then what I would have done, I know that the total is always at 100%. I would have taken 100%. The net here was 4. So 100% over 96%. Total is always at 100%. Times 480,000. Can somebody confirm that this will give us 500,000 exactly? Somebody confirm there. Somebody confirm there. Will give us 500,000 exactly? Yes. So you hear that the issue cost is 4% of net. To get the issue costs alone, you take 4% over 96. times that. So we have 20,000. Abracadabra, you guys now are not even giving me figures, abracadabra. So abracadabra, abracadabra. So abracadabra, what do we have down here? Abracadabra. Abracadabra, what do we have down here? Are you able to give me this figure for debt? For debt, 6531. For me, I know you have decimals, but I would want the really whole numbers here because I'm a nice ninja. I'm a nice ninja. So then this plus this gives me what total? This will give me 326. 326, 326, 531, like that. So basically, this is the financing structure. But now I want their effects. I want their effects. And the effects normally come from here. The effects normally come from here. The effects come from it there. The effects come from there. So getting the effects really is not even hard. So many students cry about effects. Hakuna kitu. Nothing. So we start with effects of issue costs. Issue costs. So we start with equity issue costs. Equity issue cost. Issue cost is what here is 20,000. Equity issue cost is 20,000. Always issue cost must be in brackets. When you're looking at the effect, issue cost must always be in brackets. All right. Then you come and add, in this case here, the tax advantage. So add the issue cost tax advantage. Tax advantage. It will be 0 always for equity. Equity issue costs are never allowed for tax. Equity issue costs are never allowed for tax. The only issue costs which are normally allowed for tax purposes are the debt issue costs. Debt issue costs. Remember, equity, even for example, dividends that you get out of equity ownership. Dividends can never be allowed for tax. Anything associated with the equity can never be allowed for taxation. And that is what the question has told you. That is what the question has told you. This is what the question has told you. This is what the question has told you. Assume that the debt issue costs are tax deductible. The others are not tax deductible. So then you leave it like that. So you go to the next one. Effect, or the next one is what here? All right, kidogo. Kwa hivyo umekuja pata present value. Present value of issue costs. Present value of issue costs. Debt. Itakuwa negative what here? Negative 20,000. Evo, negative 20,000. Why am I calling it present value? Because it will be in the card today, but I'm buying the project. So this amount will not be discounted. This amount will not be discounted. All right. And then now you go to debt. So debt. And if you allow me, I should be able to wrap this. So now I'll go to debt. I'm almost finishing. I can see Winnie crying there. Here there's nothing to cry, Winnie. Winnie, I'll tell you things to cry about. Not this one. This one I can get all the marks. Things that, I'll be able to tell you the tough things. These are tough. So in this case here, we have the second one. The second one, this here. Effect. Of course, you guys have this headline. Let me not even write it. So we have here issue costs, debts. How much? Always negative, 65.31. And then we have in this case here, add issue costs, tax benefit. So this will be 33% of this 65.31. Are you able to give me that figure? Are you able to give me that figure? 21.55. 21.55. Positive now. Because it's a cash inflow. So then give me the net. So then that will be present value of issue costs, debt. What's a line in the line? More than the cash outflow and then the cash inflow. How did I subtract? And if I go positive, I'm adding there. So please add there and give me a figure, please. Add there and give me a figure, please. 43.76. 43.76, like that. 43.76, like that. So up to there, are we together, ladies and gentlemen? Up to here, are we together? All right. Now we go to the last step. So this last step, ladies and gentlemen, is quite an interesting one. It's quite an interesting one. I like when students are asking them, should we, is this very term? And then when they go to the exam, they get this question as question number one. Of course, figures change, then they keep on now again, casting. How are you? I would really concentrate. There are questions you have to understand. There are questions you must understand. After all, even if those concepts are not tested there directly, you'll always get them spread. All right. Now, ladies and gentlemen, from there, we will look for the interest. The last step is the interest tax benefit. The interest tax benefit. This is the last step. The interest tax benefit. Very interesting. Interest tax benefit. So first of all, I would want you guys to give me the interest per annum. Interest payable per annum. Is there somebody who is able to give me this interest payable per annum? Interest on debt. Ah, great, Wilfrida. Wilfrida, great. Remember the total debt. Una kapesa. Utaomba mpaka zile issue cost. Hauna kapesa. The total debt ile imeandikwa hapa hii ndio total debt. So itakuwa ni 10% or 326,531. As a whole number, please give me this figure. As a whole number, give me this figure. 10%, 326,531. As a whole number. Because hauna kakitu. Hata ile pesa za kuissue hauna, so unaomba kila kitu. So inakuja according to Frida 32,653. 32,653. Thank you very much. So remember, this is per what year? This is per annum. Now, at this stage, I need to ask myself, before I do any discounting here, am I going to do a loan amortization schedule in this question? Am I going to do a loan amortization schedule? Let me share the paper and then we discuss. Let me share the paper we discuss. Am I going to do a loan? Remember, we only do a loan amortization schedule whenever you are told that the amount, the total loan taken here is going to be paid like in 3 equal installments. Like 3 equal installments. When you're told that the amount will be paid like in 3 equal installments. Here, there is nothing to be paid in between here. The only thing we'll be paying, ladies and gentlemen, is interest, and then, of course, at the end of the 3 years, we have, in this case, the bond being redeemed. This is a redeemable bond. Redeemable bond, we only account for interest. Principal is never paid in between here. Like the question that I did yesterday, ladies and gentlemen, we did, if you remember very well, the question that we did yesterday here, we were told that the loan is paid in 3 equal installments. Of course, when they say loan, it's principal being paid in equal installments plus now the interest. So in that case here, we were able to do a loan amortization schedule, which these guys have never tested us directly. I wish this time around, because of the real estate, they give us a question on loan amortization schedule as a standalone. So here I'm not doing loan. So here I'm very lucky. And remember, this interest will be paid equal. So somebody is telling me, Mwalimu, first of all, before you know what I'm looking for? First of all, it's a tax benefit. So then go ahead and give me the interest tax benefit. Interest tax benefit. So the interest tax benefit, I will take the interest itself, 32,653 times that 3%. Times that 3%. Is there somebody who is able to give me this figure? Is there somebody who is able to give me this figure? This question is the same as June 2013 question 3B. They repeat exactly. I know. They repeat exactly. So 10,776. So this is 10,776 like that. 10,776 like that. So now, ladies and gentlemen, this is the amount that I will be paying on a per annum basis. So then are you able to give me now the total present value? So total present value of interest tax benefit. Interest tax benefit. This will be 10,776 times PV-FAR. PV-FAR 3 years. It's a 3-year loan, remember. What is the cost of capital given? Remember, if I had KD, I would have used KD here. Whenever KD is not there, always use risk-free rate of return. Risk-free rate of return. Do we have the risk-free rate of return here? Do we have the risk-free rate of return, guys? They are not talking to me now. I'm an enemy. Now I'm an enemy. When I want to help these, my professional children, these are my professional great children, great ninjas. When I want to help them, now hawataki kusaidika. When I want to help them. So at risk-free rate, ladies and gentlemen, what is the risk-free rate of return? Somebody is telling me it is 2 point. It is, or rather it is 10%. 10%. Yes, so 10%. So is there somebody who is able to read this for us? PV for 3 years, 10%. PV for 3 years, 10%. PV for 3 years, 10%. What do we have there? Somebody 2.48. Oh, we amesoma PV, but we shall overcome. We amesoma PV. So it is 2.4869. We'll check again. Ninja win, check again, check again, check again. So up to here, ladies and gentlemen, are we together somehow? Are we together somehow? Up to here, are we together somehow? Don't use scale here. Remember, this is a debt instrument. If it's a debt instrument, whatever returns are coming from that debt instrument, we shall always use what here? We shall always use KD. KD. It is saying somehow, yes, we shall overcome. We shall overcome. So then at the end of the day, what do we have there? At the end of the day, what do we have here? 26,799. 26,799. 26,799. 26,799. Thank you very much. Now from there, you come and do a summary. Do a summary for us. Do a summary for us. So go ahead and do a summary. So go ahead and do a summary for us. A summary for us. So are you able to do that summary for us? Go ahead and do this summary for us. The last thing really, do the summary for us. This summary will look like this. This summary will look like that. So you have your base NPV. Please write down the base NPV. We have our base NPV. We have our base NPV. Are they able to remember that base NPV? So summary, base NPV. So base NPV, base NPV. Then we come and add the interest. We add the interest tax benefit of 26,799. And then we less issue costs. We less issue costs. And our issue costs are 2. We less issue cost, and our issue costs are 2. Our issue cost, we have an issue cost on equity. And the issue cost on debt. I'm not able to remember the figures very well, but at least the base NPV, we're able to remember the base NPV. Is there somebody who can give us this base NPV? Is there somebody who can give us this base NPV? Is there somebody who can give us this base NPV? 73, right? 73. Oh, you guys, you forgot you were using, you guys forgot that you're using 3 zeros. So if you're using 3 zeros, then this should be what here, somebody? 26.8. This should be 26.8, isn't it? Because you're using 3 zeros. Also, issue cost, we forgot that. You should have cut 3 zeros throughout. We should have cut 3 zeros throughout. So issue cost on equity ni ngapi? Issue cost on equity ni ngapi? Issue cost on equity ni ngapi? Issue cost on equity, we should have cut 3 zeros. Issue cost on equity is 20. How about issue cost on debt? Please cut 3 zeros. Cut 3 zeros because we forgot to cut ourselves. Cut 3 zeros. Cut 3 zeros. Cut 3 zeros. 4.4, right? 4.4, right? We are cutting 3 zeros. 4.4. Is 4.4 correct? If you cut those 3 zeros. If you cut those 3 zeros, are we getting 4.4? Are we getting 4.4? We am alone. Please go to the issue cost. If you remember the issue cost, the present values, This has to be present value. Always, you don't discount them because they are recorded at source. Issue cost 4.4, yes. So then come and consolidate here. Whatever you have here is the APV. So 73 plus 26.8 minus 20 minus 4.4. So whatever we get is the APV. And if it's positive, now we can shout. We can shout variable. We can shout variable. Is it positive or are we getting a positive answer? 75 point what here, somebody? Why 4.4 purity? Do you remember up there we did some working? We did some working on present value of issue cost. We got 4,400 and something. Now, because we want it in thousands, we have divided this by 1,000. We have divided this by 1,000. We have divided this by 1,000. Do you remember that? All right. So what is the final answer for APV? What is the final answer for APV? Minus, no. That's why, it's a cash outflow. It's a cash outflow. Both of them are cash outflow. So if you put like net, it's like you'll be adding the cash outflow. But of course, I understand what you're talking about. So then the answer, of course, they used are very, very different. You can see they're around 67 point something. As we are around 70 because of that error of 16% vis-a-vis what here? 16% vis-a-vis that concept there. Vis-a-vis that concept there. Now, is this question like very hard, like you cannot, out of say 16 marks, like you can't fetch 10? Is it very hard? Because I can see students who are really crying. I can see students who are really crying. Is it very, very hard? Is it very, very hard that you can't get even 9 or even, is it very, very hard really? I don't think so. I don't think so. Not very bad. Even lengthy. In AFM, I'm so sure the guys who are complaining here, they have never tried this AFM paper before. Do you know in AFM, you can go there and you lack even a single question that you know. And perhaps this pops up and it's the only question that you know. And for you to scare now your neighbors, what do? You keep on writing this one like forever. You scare them out of their skin. Because now they don't be able to write anything. They won't be able to write anything. So in AFM, you can't really argue like the question is long because you don't have a time problem. Actually, you'll be having, in this case here, a writing problem. What do I write? Don't be AFR will have a time problem. But AFM, it's a writing problem. I've seen students in this case here turning in AFM questions without any mark. The only thing they write down there is God bless the work of my hands. That's the only thing they write. So instead of going to write there like God bless the work of my hands, why can't you be doing this like even 3 pages? And it can really, really help you. Because the examiner sees that a student has been able to write. Yeah, student has been able to write all these worksheets. This guy will get. I was out, you see, 30 minutes. Because at times you go to an exam and you're not able to see even nothing, right? Even nothing, right? No. I'll not give you any other. I would only want you to, Joy, thanks for that. But I would want you to go and concentrate on this question alone. You concentrate on this question alone. Concentrate on this question alone. So I can see that the number is reducing. It's like this or rather whatever subject you guys had. I think it was a miscommunication, really. Maybe I should have made it clear to the other teachers that we have AFM at that time. We shall understand. Yes, we shall understand. We should be able to understand. Yeah, that one I can provide. Now, Maggie, thank you. And now it comes with the subsidy, when there is a subsidy. You see that subsidy also, you have to take it and discount it. But whenever there is a subsidy, you are always better off, in this case here, not handling. Handling every other thing, subsidy, leave it to the examiner. Tell the examiner, I've left that for you. I've left that for you. Is that okay? Fortunately, your exam this time around will be quite a nice one. Will be quite a nice one. Revision question. Very hard. Tackling this in exam is a show off. But you guys then are not getting this. And I'll not actually do another question for you today. Today, I think you guys are not ready for studying. Because I wanted you to see the glass being half full, not half empty. But there is something you can write at the end of the day. For example, you don't know how to get a Q. You guys today, I think you're not yourselves. You don't like other days. Volume, how can one remember formulas? Good question there. Good question there. How do we get to remember formulas? It is just by practice, imagine. And there are not very many formulas in AFM. People keep on there are not very many formulas. What I would advise, go to each topic that you have. Like do like two questions from each topic. So if it's portfolio, and sure you do any 2 questions there. Go to, for example, money markets or whatever, do 2 questions there. All right. And then you will be good. Right now, don't start doing what you do not know. New things now, we shall say no. Now you only want, in this case here, things that Mwalimu has done, or things that Mwalimu, me, I can do new things still. Things that Mwalimu will be doing. Because if you start again looking at these things, new questions yourself on your own, you will see like you know nothing. And trust you me, whatever you have plus the theories, which I'll be doing, you guys are good to go. You guys are good to go. You guys are good to go. Arbitrage, okay. No worries, we shall overcome. That's why we are here. Don't worry. No worries, no worries. We shall be able to do that. So, the gentlemen, what we shall do is to take a break. Take a break. So, I don't know, but today I have BD at night. Today I have BD at night. I have BD at night. We shall overcome. We shall overcome. Yeah, theory class. Already I've finished, I'm almost finishing the theories of AFR. Now from there, I'll be able to come and pick the theories of AFM, which are quite few and are very much known. Assumptions of this, assumptions of that. And then we shall be done. We shall be done. We shall be done. Okay, great. Rebecca, I've seen that. Saturday class, I don't know, you can check that FB. LM morning, ilikuwa recorded. You nilifanya kwa FB. LM morning, not even FB, other YouTube. That one I'll be able to share with you. YouTube, Joshua Aura, Leadership and Management. You'll be able to get it on YouTube. It is there. It is there. We did something great there. We did something great there. Great. Otherwise, ladies and gentlemen, please have yourselves a good afternoon. A good afternoon. And please, as usual, you guys are very, very good. Because, I mean, we started something like a joke. This from Form 1 to Form 4 tuition. And it has more than 100 students now as we speak. More than 100 students now as we speak, which is really, really a good thing. Parents are paying per subject 400 shillings. 400 shillings per week. So for 3 weeks, 1,200. So if there is anybody who has got a brother, a sister, somewhere, don't hesitate in this case here. Don't have those children just staying idle in the house. No, let's get to learn with them through Zoom. I've checked in this case here, you get like, I was teaching chemistry. You get like, ladies and gentlemen, people are being asked like, could be given like, I know most of you have forgotten. Like we have an atom. Of course, an atom in this case here will be having some things inside, if you remember. All right. We have protons. We have so many things. So you go and get, for example, somebody has given you number of electrons. For example, they are 17. They are 17. And then you are told to give us an electronic arrangement. I'm so sure you have forgotten. Me, I have not forgotten. If it is 17, chemistry, Form 2, if it is 17, I always use the staircase approach. So the first stair is a baby stair. It starts from 2. The other stairs are always 8. They are always 8 like this. So like when I do 2 plus 8, that is what you're 10. 10 plus 8, that is 18. You see, that surpassed 17. So I'll come and cut this. So I'll be able to know that this is what here at 2 is to 8 is to 7 electrons. So when I was teaching this, these guys, I mean, wondered how comes we have not been taught this. It's not about your kid at times. It is about the kind of teacher they have. So, and we are here to help them. So in this case here, what you need to do is to give us a call, 0793 555 000. We should be able to help them. We should be able to help them. Otherwise, thank you very much. Even this FM, we are passing. Don't panic at all. We are passing. Thank you and bye-bye. Bye. Bye. Oh, goes at every gadget in my house is set to give an alarm. All right. I'm a miss. Morris, who got a problem. Luciana has been around. Luciana has been around. No, the teachers, we got many teachers. Yeah. What will apply paka nikashindwa kuchagua? You got many of them. Thank you so much. Kwa LMS. Okay, sawa. Direct kwa LMS. So thank you very much. Be blessed.